introduced beer on Patriots Day, which is a mass holiday. He had an initial investment of $100,000, which is, not terrible considering where they ended up, and voted America's Best Year in 1985. So if you do want to kind of look at this, the reason why I'm doing that is that I found when I was studying accounting, because if you don't know, I actually was an economics major, business major, and then went back to accounting after playing golf for a few years, just because there's no jobs for economists, so learned accounting. But what I found is, because it didn't come naturally to me either, is that it had to have a story. The minute I felt like I was curious about Sam Adams, then it made it less painful to first learn how to look at financial statements or balance sheets, right? So that really helps, is, rather than just understanding the fundamentals, but making it real, making it have a meaning, can help in learning some of these examples. So again, if we're curious about Sam Adams, that could help, the first time we look at these financial statements, to really kind of make it feel something not so overwhelming. Okay, so why should we study Sam Adams? Well, hustle means something, and then understanding or doing some research in the company can help us in understanding what the balance sheet is telling us. So do we think Sam Adams is growing? Well, let's go look at the balance sheet and see if it looks like it's growing. So some of that can also help in understanding the why of what a balance sheet is. So again, focusing on the balance sheet, the reason is because in accounting world, a lot of times they call it like balance sheet accounting, actually. So when your accountant takes your tax return at the end of the year, their primary goal is to make sure the balance sheet is correct. And the goal of that is the rule of that is if the balance sheet is right, then the P&L has to be right. So that's why we're starting with balance sheet, because it actually, of the two, is the more important in the accounting world. Operationally, P&L, right? Because you need to know your margins and your prime costs and all of that. In the accounting world, the balance sheet is the most important. So that's why we're going to start with the balance sheet. And fundamentally, what the balance sheet is showing us is that my assets, which we'll get into what an asset is, must equal my liabilities plus my equity. So no matter what company I am, no matter what time period I'm looking at, this accounting equation always holds true. Now, the interesting thing is with software, a lot of us never see this, right? Like we put in stuff in QuickBooks and it just magically appears on a balance sheet somewhere. But it is good to understand this equation, even though, we don't, used to be you had to worry if a balance sheet tied out, if it actually did balance. Like I remember when I started out, it was like you could have one that doesn't balance. Software makes it where that's not really the case, right? It always will balance. But the more important thing is, are my assets really assets? Are my liabilities really liabilities? And then my equity really equity? That's really what we're looking at, is how things have been categorized to make sure that my accounting equation is correct. So what are my assets? The important thing here, and the difference between why accountants find the balance sheet is more important than a P&L, is the P&L is for the current period, right? So we give weekly reports in what we do. So if I give you a weekly report, that's showing you what happened last week. The balance sheet is the health of the company as of a current date. And in the case of assets, these are things that actually have future value, which make them in the accounting world more insightful than just the P&L, which is, that was revenues last week, but what's coming in this week, right? Those were expenses last week, but what's coming in this week? The asset is a future value. So my cash has future value because I could spend that on things. So if I'm looking at a balance sheet and I see, cash, if I'm using, I like using a lemonade stand as an example, just to keep the numbers small and make it something that we kind of all can see in our head. So if I'm looking at a assets of a lemonade stand and they have $5, right? That means they can buy $5 worth of something in the future. That's important to me, right? That tells me, do they have enough cash? Again, in COVID, do they have enough cash to get through a month? If say they don't have another dollar coming in for a week, is $5 going to be enough? So cash is really important to see. The other thing on my assets, especially if you're a restaurant, would be your inventory. Again, these are things that you have not sold yet. So they have future value beyond today, especially for you guys out there that are brewers, right? You have your beer inventory. Maybe you produce, for the next 2 weeks, 3 weeks, 4 weeks, more. That's the value, future value. Beer you could sell tomorrow. The other very important thing, if you're looking at your company or any company, is to make sure that your fixed assets are accounted for correctly. So in the case of a lemonade stand, the stand, right? You don't know how many times we start with a new client and we're looking at a balance sheet and, say it's for a lemonade stand and I don't see the stand, right? Which could possibly be the case if he's renting the stand, maybe that's what it is. But it also could be the case that you didn't start the QuickBooks file till like a month or 2 months after you bought the building or you bought the business. And we never think to add the value of the business to our balance sheet. So if I were you guys, the main thing I would be looking for, do my assets look correct? Did my initial purchase, my initial investment, did that get captured? Because if it didn't, we really want to make sure that we get it on there. Why? Because if we go to sell, and I've seen this, where somebody went to sell their business, and all of a sudden their tax accountant turns to them and they have this huge tax liability. And they're like, how is that possible? Like, I bought it for $100,000, I sold it for like 110 after 3 years of operating. How could I possibly owe the government this much money? Well, they didn't have the initial 100,000 investment. So all of a sudden it's fully taxable. So that's where we really want to make sure what we call our fixed assets, or our building, our equipment, our fixtures, our car, if we have a car, all of those things should be in our assets of our company. Because again, when you're presenting your financials, if your assets are understated, it's not making your company look as healthy as it should. So very important thing there for any size company, right? If I'm looking at the value of the lemonade stand, that means, it cost them $50 for the stand, but that has future value because he's going to be able to use that stand for the next months, years, all of that. The next thing to understand here is depreciation. Now, we'll get into this a little more in a little bit, but basically what depreciation is the accounting way to spread out the cost of that asset over the time that you're going to use it. So in the case of the lemonade stand, it cost them $50 on day one, but it's not something that only is used on day one and then thrown away, right? It's something that's used on day one, day two, day three, 5 years from now. So depreciation is spreading the cost over the 5 years. So over the 5 years, I'm going to show a portion of the $50 until I get to zero. So when you're looking at a balance sheet, again, you just want to make sure that the depreciation is there because the assets do depreciate, and that it gets updated every year as part of your tax return, just to make sure that you're in agreement. So that gives me total assets of $55 for my lemonade stand. Well, is this good? Is this bad? I don't know yet, right? I'm only on one of my accounting equations. So I'm at assets. So there we go. Those are my assets. Now, the next part is my liabilities, right? What do I owe in the future? Because again, balance sheet is about today looking forward. So what do I owe tomorrow? What's outstanding that needs to be paid? So liabilities are things that I owe. So my accounts payable. And again, when you guys, whether it's now or down the road, if you want to look at your balance sheet, accounts payable, at least look once a month at your payables. Like, are those really my payables, or are there things I just need to clean up here? Happens all the time. Just want to make sure we have a good accounts payable balance, because those would be your vendors, things that you owe. Next one is your employees. Now, we don't have to, account for that every week, but it is good to be aware of the fact that you're always paying backwards for your employees, right? So when you get to the end of the year, chances are that first payroll in the next year is probably a 2019 payroll, or going into 2021 is a 2020 payroll. So we want to make sure that on our liabilities at the end of the year, we've at least looked at, what is the payroll I paid in January, and should that really be in the last year? The reason is, obviously, that could help your tax liability, right? So if your accountant is ever asking you for your January payroll, because he's looking for additional expenses, right? Because if you paid it in January, but it's a December payroll, we may be able to put it in December as an expense, right? Just something that you haven't paid yet. Other things, think about bonuses, right? If you had bonuses that were paid in January, but they really were December bonuses. So things like that are owed in the future. And when we're looking at a balance sheet as of a current date, what we're looking for here are things that are owed in the future. And we want to include them now so that we have our liabilities, everything we owe. Same with our long-term liability. for my lemonade stand, maybe he took out a loan from his mom to buy the stand. Well, now we want to put that, what he owes in the future. So when the accountants are going through your balance sheet, what they're looking for is, as of the current date, what is left to be paid on these balances. And that would get me to my total liabilities. Okay, so I thought I saw someone raise their hand. Okay, so really what we want here is, so now we have our liabilities, right? And we should be pretty close, or maybe not always, but we have our assets and we have our liabilities. And a lot of times when you're giving this to a lender, that's what they're looking at. Are your assets more or less than your liabilities? And that would kind of give us a benchmark for the health of the company. So making sure that they're both good numbers is very important. Again, going back to the car, even if I bought a car today, I would, add the $10,000 or $15,000 for the new car, but then I would also add the liability for what I owe, right? So that's where in accounting, it always is going to be in balance, because I'm going to have my asset of my car, my liability of what I still owe, and if I paid anything down, that's going to be decreasing my cash. So I'm always in balance between my assets and my liabilities and equity. Okay, so the third one here is my equity. So this one gets even more confusing in the QuickBooks world. So a lot of times it may just be kind of digging in here and understanding how the account was set up, what these accounts are, and here I would say making it what it should be. Right? So a lot of times in QuickBooks, because remember what I said at the beginning, the software has to balance. So a lot of times QuickBooks will create these random equity accounts because it has to be in balance somewhere, and that's where it goes. So if you ever see like an opening balance equity, those are things that sometimes are automatically driven based on other information that QuickBooks has been given. So what we would want to do is really make sure those numbers are correct. So your equity should show your initial investment, usually shown as opening balance equity or owner contribution, something to reflect the money that you've initially paid in. So if I initially put $10 into the bank account to open the bank account, that $10 is additional cash, but it's also additional equity, right? Because I have given the business $10 to start. So anytime you as the owner put money in, the key here is you want to make sure that it's getting captured, that you're getting credit. So if during COVID you had to put in $5,000 in April just to make the next payroll because things were so bad, you need to make sure that you got credit for that contribution, because so many times it can just get lost, in one of the asset accounts. But we need it to show as your contribution, because in the tax world, your contribution dictates how much of a loss you can take, or the credit you get, as well as when you sell the business, your basis in the business. So we really want to make sure that if you were putting money in last year, let's really make sure it got captured before you file the return, because that is a very important number going forward. So that is your investment. And again, if it's kind of set up weird in QuickBooks, I would just take a look at what it should be, and then can figure out how to adjust to get it to the correct number. The next piece of equity is what we call retained earnings. So these are actually the earnings of the business over time. So if you're looking at your QuickBooks, again, that's an automatic number. That number, you cannot touch it in the QuickBooks world. So that carries forward from all of your past earnings. So if you're looking at your retained earnings, you're like, I have no idea. That's okay. That's one of those numbers that's just a calculation from other information. And in this case, it's your earnings over time. And then the next one that we want to make sure that we're capturing correctly are distributions. Did you take money out, right? Maybe not April, but do I take, $1,000 out every month, or do I take $2,000 out every month? Not through payroll are you actually taking cash out of the business. So that's, an owner distribution. Now, the one thing here that I think, kind of goes back to some of our cash flow discussions is, if you're not necessarily taking $1,000 out, but you're using, the debit card for random owner draw things, right? You at least want to just make sure that it's getting captured in the right place so you can track it, because that does help on our cash flow of where the cash went. Again, it is what it is, right? but we just want to make sure that we're capturing it in the right place, because collectively this makes up my equity. And that tells me that, you know, I have my owner investment plus what the business has earned over time, and that gets me to my equity, which then makes me in balance. Okay, so let's understand our accounting equation. Again, if I had assets, I had assets of 55, I had liabilities of 48, and I had equity of 7. But now we went through and we kind of understood what those numbers were. Now, there's no good or bad necessarily, right? This is what it is. This is as of a certain date. This is how my company is. And, you know, the real thing here is understanding the change, right? How has the company changed over time? And that would probably give us better information. But unlike a P&L where, you know, you can look at a P&L and go, oh, that was a bad month, right? The balance sheet isn't like that. It's telling us as of a certain date how things are. And again, with more of a forward-looking approach. Okay, so now let's look at Sam Adams, right? So that was sort of the basics, but let's apply it. What does this look like if you are in, you know, if you're looking at the financial statement of Sam Adams, what does this look like? Well, I uploaded the annual report for 2018, and take a look. I think some of this is confidence, right? And I see this, you know, in clients that I work with even people who join us on our team. Accounting can seem overwhelming at first, but the more that we look at it little bits every day, 15 minutes a day, commit to going, you know what, I'm not going to let these numbers overwhelm me. This is the language of business, right? This is Sam Adams telling a story, and it may look overwhelming, and the way they present the public companies is, you know, meant to look a little like, you know, intense. But if we get down to the nitty gritty of it, we should start to at least, you know, try to make sense of it. Because if we can make sense of a Sam Adams, you know, corporate annual report, then we can look at ours, and ours is going to look a lot better. I promise. It's a lot easier to look at than the corporate ones. But the corporate ones are good because it really helps us understand the structure. So again, looking at Sam Adams, what we see is they had assets of $631,000. They have liabilities of $179,000, which gives them equity of $460,000. So how do we know if this is good or bad, right? Unlike the P&L where it's, you know, red or black at the bottom, and we can tell. This is a little less, right? But we do know that their assets are a lot bigger than their liabilities. So at a minimum, just by looking at these three numbers, we could say, you know, that looks strong, right? Because if you saw the reverse and you saw liabilities of 631 and assets of 179, you know, that wouldn't look as strong. So right off the bat, we know, hey, you know, we definitely have more assets than liabilities, which is a very good place to start. But the next thing is a lot of the balance sheet is doing a 2-year comparison. So what we would want to do, and what you'll see in the financial statement, is that it presents 2 years together. And that gives us context in the numbers. So if we're looking at 18 versus 17, we could actually see, oh, look, you know, they had 108,000 of cash at the end of 2018. They had 65,000 of cash at the end of 2017. So, hey, that, you know, cash went up. That's a really good thing. The other thing here, and again, you guys know so much more about accounting than you think you do in a lot of cases because you're operators, right? You run businesses, good businesses. So right off the bat, the main thing here, and I think anyone who's an operator would agree, is the inventory, right? Like, is that good inventory or is that bad inventory? Because if they have, let's say, 70 grand on their books, but half of it's bad, right? That would probably be their biggest risk in the assets, because cash is what it is. It's in the bank. You know, your property, plant, equipment, like everybody's going to want beer equipment, so that has relatively little risk. But in the food world, you know, the risk is the inventory. Is the inventory accurate? Does it include, did they write off for waste and spoilage? I mean, a lot of times I see if you guys aren't taking regular inventory, it's like, it's a number that's been there for 3 years on your books, right? And you have no idea. Like, inventory shows at $15,000. They're like, I don't know, right? So that's the number. We want to at least know what's there for our inventory, and maybe we adjust at least at the end of the year. But if I'm looking at an asset, and especially in a Sam Adams, and seeing, well, I mean, they have 630,000 of assets, they look really healthy, you know, maybe digging into like the change in inventory. Here, didn't change much. I think that's fine. The other thing here would be receivables. So for you guys in operating, a lot of times, I mean, you're going to get paid because people come and they take the food and you get paid the same day. But anytime you do a catering event or something where you are giving people terms, you know, that has a little bit of a risk too. So that would be your receivables and then your inventory. But overall, you know, I mean, looks really strong. And if we look at total assets, their total assets went up from 2017, which is also shows strength. So again, right off the bat, we're able to learn a lot about Sam Adams just from, you know, focusing on their balance sheet for a few minutes. So what I want you guys to do this week, and again, next week we'll do P&L. We're starting with the balance sheet, pulling the Band-Aid off. Take a look at the annual report of Sam Adams. Or if you don't want to do Sam Adams, any public company that exists does have to make their financial statements publicly available, which makes them great to study in the accounting world. So, you know, if there's a company that you're interested in, take a look at their balance sheet, because that's how you're going to start to learn the balance sheet, and it's going to be exciting instead of painful, which can be looking at our own balance sheets right now during COVID. So, you know, I'd say find something that's exciting, that's new, that you want to learn about, and look for their balance sheet, and let's do this exercise with that. And then start to go back and, you know, see if you have any questions. What do you think about it? Are you able to get a good picture of the company from the balance sheet? And you'll be amazed at how quickly you're able to learn some of these. And then taking that and applying that to your own balance sheet will make your own balance sheet work much easier. So again, hopefully this was a great session. You know, small pieces, that's the goal of this. Every week for the next 4 weeks, we'll have bite-sized pieces, and then be able to put it all together to have a really good understanding of accounting and what we need to know about accounting for our business operations. So please feel free to reach out if you have any questions, and thank you so much for attending today's call. Have a great week. I will see you guys next week.